the Jet Setting Wealth Advisory Podcast, where your financial journey takes flight with David T.U. As an airline pilot and financial expert, David merges the aviation industry and wealth management to help you navigate today's complex financial skies. Each episode features expert insight, blending personal stories with essential financial strategies. We ask that you fasten your seatbelts and sit back as we prepare for takeoff. Our destination, your financial empowerment.
Hello, and welcome to the Jet Setting Wealth Advisory Podcast. I'm your host, David T.U. And today we're absolutely thrilled and honored to have Michael Kramarz as our guest. Michael is a principal in Kaufman Rossin's Tax Service Advisory Group, where he leads the federal tax controversy and dispute resolution practice. With over 14 years of experience as an attorney and a former IRS Special Trial Attorney, Michael has expertise in navigating complex tax matters, including IRS examinations, appeals, and collections. Since joining Kaufman Rossin, he has successfully resolved many high-stake tax issues for his clients, from employee retention credit cases to abatement of large penalties on foreign information tax returns. Michael's insight into tax planning, dispute resolution, and high net worth strategies make him a true leader in this field. Today, we're absolutely honored to have Michael on, and we'll explore his expert advice on managing IRS disputes and achieving tax efficiency. So let's get started. Welcome, Michael.
Well, thank you, David. Thank you for having me. Really appreciate the opportunity to be here today.
Oh, we're absolutely thrilled to have you on board. So let's just get right to the questions that I'm sure many of our listeners and viewers are going to be excited to hear about. Share with us, Michael, can you provide us a little bit of your journey from not necessarily when you're a little kid, but what led you to the specializing in the tax laws and eventually during Kaufman Rossin?
Sure. Well, it starts with the University of Florida, where I received my bachelor's and master's in accounting. And while in the accounting program there, I was focused more on tax than audit. I mentioned to them that I was really interested in tax, but I didn't necessarily know that I wanted to prepare tax returns. I wanted to do more. And she introduced me to the world of tax law, which is something I was not familiar with. I'd heard of tax attorneys, but I didn't necessarily know what they did. So at that point in time, I decided to go to law school. I went to the University of Miami School of Law, where I received my JD in LLM and tax. Since I knew I was going to focus in on tax, they have a 7-semester program there that I took advantage of. And while at the University of Miami, I thought I would be like most tax attorneys, sitting in a corner office somewhere of a building in downtown Miami, planning transactions for my clients. The time that I was at University of Miami was 2008, 2009. So it coincided with the downturn in the economy at that time. And jobs were a little bit harder to come by than I would have liked. Fortunately for me, one of my professors worked at the IRS Office of Chief Counsel, and he made an announcement in class one day for an internship. I applied for the summer internship. I obtained the position. I thoroughly enjoyed working there over the summer. And considering I didn't really have any other job opportunities at the time when they offered me full-time employment, I gladly accepted the offer. And that started my journey at the Office of Chief Counsel. I was there for 12 years, the last 5 of which I was a special trial attorney, focusing on litigating largest and most complex cases in the United States tax court. It got to the point where, even though I really enjoyed the job and litigating the cases, I wanted, quite frankly, to seek additional monetary compensation. The government only pays so much, and while the work was very meaningful, I have 2 young children, and so I therefore wanted to go out into the real world and, monetize my experience. And so that's what led me to Kaufman Rossin. It was a good opportunity for me because they didn't previously have a tax controversy department. So this was an opportunity for me to start something on my own, and I really enjoyed the entrepreneurial aspects of this. So I got to combine my entrepreneurial spirit with my tax law knowledge and experience at the IRS, and Now I'm responsible, as you mentioned, for representing our clients before the IRS in examinations, resolving penalty notices, and assisting with collections matters, and really run the gamut of, quite frankly, anything IRS. That's something that we'll likely be able to handle because my team and I have many years of experience both inside and outside the IRS.
So let's dig in a little bit regarding your special trial attorney status at the IRS. What was your experience like working there as the special trial attorney for the IRS? And how has that helped you shape your approach in helping your clients today?
Sure. Well, as a special trial attorney, you're responsible for leading trial teams of other attorneys in some of the largest and most complex cases in the United States tax court. So as a special trial attorney, you really dig into the specific issue of your case. You become not only just an expert in litigation, but an expert in these very technical matters that are before the tax court. And so digging into these very detailed and, let's say, deep technical tax issues have allowed me to apply that on the outside with respect to my clients, because it teaches you how to do the research and learn how to find solutions and answers. The tax law is quite expansive, right? You're not going to know
Absolutely.
every single code section or regulatory provision. It's not possible. So by learning how to untangle some of these very complicated tax matters, I'm able to take that learning process and knowledge and apply it to other code sections. So what I like to tell people is, I'm a tax generalist. I don't specialize in any one particular area of tax, but what I specialize in is finding you an answer to hard to answer questions, because I'm able to dig through the tax code, the regulations, case law, and other guidance, and kind of put the pieces of the puzzle together and either find you a path forward with respect to your planning matter or in responding to a specific IRS request.
Fantastic. Okay. So you've represented the IRS in over 200 cases. What are some of the common mistakes taxpayers make during examinations or in their disputes?
Sure. So I think there's two common mistakes. One, kind of on the front end, that taxpayers can better plan for an examination. A lot of times there's personal expenses, for example, that get caught up within your overall, business receipts. You got to make sure that you extract those and not deduct them. And then the other one is, quite frankly, making sure you have the proper substantiation and documentation. A lot of times during these examinations, clients lack records, and it's not as if they did something wrong or that their deduction is improper. They just don't have the proof to back it up. So making sure you maintain your documentation is very important on the front end. And then during the examination itself, if you were ever to find yourself before an IRS revenue agent or revenue officer, you have to understand that they're human too. They're just trying to do their job. They are not out to get you. So acting in a professional and responsible manner, responding to their requests in timely, not acting unprofessional. These are little things that you can do to help engender trust with the revenue agent or revenue officer, because you never know at some point during the examination when you may want something from them. Maybe you get to the end of the examination and they're considering whether to impose penalties. Well, if you've been, let's just say, upstanding in the way in which you approach the examination, then it's possible the agent will cut you a break and not impose that penalty. But if you're rude or not responsive, then, as a human, they're going to want to react to that. And so you never want to give the IRS a reason to do something. And so therefore, I always try to tell my clients that you need to not only make sure you've got your things in order before you get into that exam, but once you are in the exam, how you present yourself is very important too.
So personal etiquette and basic courtesy and respect as a human to human does account for something.
It really does. I mean, you'd be surprised at just how far you get with just a little bit of common courtesy.
Okay, that is advice that everybody should take and take it to heart. Let's continue. So can you walk us through the process of an IRS examination and what steps businesses or individuals can take to prepare effectively for an examination?
Sure. I mean, understanding the process is very important. So that way you know what to expect as you go through each step. The process is a little bit different depending upon what operating division of the IRS you're in front of. There's LBI, which stands for Large Business and International Division. That's a division that I come from. Those revenue agents handle the larger, the more complex issues and cases. And then there's SBSE, which is Small Business Self-Employed. Those are for taxpayers that like entities that have under $10 million in assets. So there's a little bit of different formalities and the processes with each operating division, but generally speaking, the examination will begin when you receive a notice for examination. So you'll get a letter in the mail and the revenue agent will introduce themselves and ask that you contact them within a certain amount of time to arrange for what's called the opening conference, or if you're an SBSE, the initial interview.
What's SBSE?
So SBSE is Small Business Self-Employed.
Thank you. Okay. This is for people who, like myself, don't have all the initials. No.
The IRS is a book of acronyms, quite frankly.
Sure.
I recall very distinctly the first year there, just trying to understand the lingo was, quite frankly, part of the on-the-job training was
sure
in and of itself. But with respect to the examinations, you'll have the opening conference or initial interview. That's the IRS's opportunity to learn more about you as the taxpayer. Now, you have to understand, the IRS, they have your tax return, but they don't know anything else about you when they select you for examination. So they need some type of context or orientation in which to understand the information and documentation that you'll be producing during the course of the exam. And then they also have a series of just compliance check questions that they're going to ask. One of the first things that you'll want to do is to prepare for that opening conference initial interview, right? You're going to want to thoroughly review that tax year and make sure that you understand everything that was on that tax return and why it's on that tax return. Then there's also some very specific questions that the IRS will ask you depending upon the issues that are being examined. So they'll start off with your background. Once they have an understanding of your background, they'll ask a few questions about the tax return, but then they're going to drill down into the specific issues. So maybe it's commissions that you paid, cost of goods sold, issue with your gross receipts, or maybe more specific issues with R&D, capitalization, so on and so forth. They'll ask questions about those issues. So once again, to get that necessary background, so that way when they do review the underlying documentation, they have a proper orientation for what it is that they're reviewing. And after the initial interview or opening conference, the IRS will begin its information gathering process. And that is done through information document requests, or IDRs for short. How you present the information in an IDR is extremely important. You don't want to just dump a bunch of documentation on the IRS and leave it to them to try to figure it out.
So no receipts in a box, and here you go in a big box.
You want
have them try to figure it out.
Exactly. You want to organize it for the IRS. What I tell people is you want to help the IRS do their job. Now, a lot of people say, why do I want to help the IRS do their job? That sounds counterintuitive. Well, no, but to your point, David, with the example with the box of receipts, if you just provide a box of receipts, then they may miss something. They may not understand what the receipt is for. There's no proper organization or context for what it is that they're looking at. So what I would normally do is I would try to organize those receipts in some fashion, maybe create a table identifying what each receipt is, the expense to which it relates. If there's additional substantiation required, for example, it's a meals or entertainment, list the business purpose of the meal, who was there at the meal or entertainment. So there's certain things that you could do to help the IRS do their job without giving away the kitchen sink, for example. If there's something there that you're trying to shield the IRS from, I'm not saying just turn it over and, as a shiny object for them to look at. But what I am saying is that if you help to facilitate their job, one, you're going to get the process over with quicker. And I could tell you clients don't like long examinations. So helping the IRS get their job done means you're done with your exam sooner. And two, you limit the chances for the IRS of making a mistake.
Okay.
So there's certain things that you could do to help prepare the IDR response. So that way the IRS then has a better understanding of the documentation they're reviewing. This is like a back and forth process. You'll produce the IDR response. Maybe the agent has a follow-up question. They'll issue another IDR. The agents will issue IDRs until they come to the logical conclusion, right? They've either captured all the information and documentation they need to write up the issue, or there's quite frankly nothing else out there and they have determined they have enough to move forward. At this point in time, the IRS has collected all the information. They can then do one of two things. They can make an adjustment, or they can issue a no change letter. A no change letter means that the examination is over, we've done our job, there's no tax to be paid, no adjustments, and you go on your merry way. The alternative, though, is where the IRS were to make an adjustment, and that would be they issue a notice of proposed adjustment. It's called a NOPE. And you would continue on with the process by filing a protest and sending the matter to the Independent Office of Appeals. So the Independent Office of Appeals is an independent function within the IRS, and they are charged with settling cases prior to litigation. So think of it as like a mediation, for example, where each side is going to present its arguments. The appeals officer will then consider both sides' arguments and will then contact the taxpayer or the taxpayer's representative to begin settlement discussions. And settlement is based on the hazards of litigation. So a basic example that I could give is, let's say the IRS makes a $100 adjustment and appeals reviews the issue and says, well, we think you have, client taxpayer, a 20% hazard of litigation, which means we think you are going to lose this issue 20% of the time. Therefore, we will settle this $100 matter with you for $20, reflecting that opportunity for your potential loss, for example, in tax court. So that's how the appeals process works. If you don't like the settlement offer that appeals makes, it's not the end of the road. You could then petition and file a petition in the United States Tax Court. And what's nice about the tax court is you don't actually have to pay the tax due in order to get into tax court. Whereas if you wanted to litigate in federal district court or the Court of Federal Claims, you would need to first pay the tax and then sue the United States in the district court or the Court of Federal Claims as part of a refund suit. So that's a whole different discussion in terms of what path to go down should you need to go down there. But generally speaking, that's the examination process from beginning to end. And of course, each situation is different and there's some nuances here and there, but that's generally speaking the process.
Okay. So let's talk about that. When a client or a taxpayer or an entity, they end up being audited, what is the percentage that you are familiar with that has the no change notice received from the IRS versus having some form of adjustment and then potentially going down the road for appeals?
So the IRS does keep statistics on their no change rate, and it differs based upon the type of taxpayer. So the no change rate for an individual is going to be different than for a partnership. And I actually recently had looked with respect to large partnerships, because the IRS has recently started to increase its audit activity with respect to partnerships and S corporations, which had historically escaped scrutiny. And my review was that the last time I checked, as of 2021, I think it was a 73% no change rate on large partnerships. So not only was the IRS in 2021, the IRS only audited 0.1% of all partnerships. So when you only audit 0.1% and then you no change 73% of those, I mean, clearly the IRS saw that as an issue with their process in terms of selection. They're not selecting the correct taxpayer. So therefore, they're not identifying those taxpayers with the highest level of risk. And then they're not appropriately training their revenue agents to go and identify these sophisticated issues and to make an audit adjustment. Partnership taxes quite complicated. And so if you don't really know what you're doing, then you're not going to be able to find the issues. So while that's beneficial to us, the taxpayer public, maybe not be beneficial to the overall, process of the IRS and auditing taxpayers, which, at the end of the day, when I was there, I was always told at chief counsel, my job was to get the right result. It didn't matter if it was taxpayer favorable or not, just to get the right result. So the IRS isn't able to even get to the right result if they're not able to train their examiners to identify these issues. So part of the funding for the Inflation Reduction Act is to identify additional revenue agents to bring on board to allow them to increase the number of audits, but then also provide resources for training so that way these audits are actually meaningful.
So what are some of the key strategies that you utilize to resolve disputes with the IRS successfully?
Sure. So I think it depends upon the particular circumstance,
Sure,
right?
absolutely.
Sometimes you're going to lack documentation and you're going to need to think of a way in which to try to save your client, maybe not the entire adjustment because you don't have what you need. So in those circumstances, you're going to be trying to basically save as much as you can. And there's different ways, for example, like when it comes to substantiation, there's something called the Cohan rule that allows taxpayers to estimate deductible expenses. This is something that should you be selected for examination, you can't find all those receipts in the boxes, for example, but you've got bank statements and you've got your testimony. So you could start to put those pieces together and argue for the Cohan rule and say that it's appropriate to estimate expenses. And therefore, maybe we deduct $100 for travel and we can only substantiate $80 through the Cohan rule and testimony and some bank statements. Fine. I mean, 80 is better than 0.
Right.
So sometimes you're just trying to save what you can with respect to an issue. Other times you need to do some deep technical research and try to find an alternative argument that the taxpayer had not previously considered. For example, the taxpayer could have entered into a transaction, had a specific basis for doing so, but then the IRS comes in and says, well, no, that's actually wrong. You can't do that. Maybe they present some, legal citations or otherwise to prove that you actually can't rely on what you thought you could rely on. And now I'm having to think outside the box. All right, what other provisions in the tax code now can we rely on to make the same argument, or not the same argument, but to get to the same result, right? To protect your conviction or preserve the income that you did or didn't report. So sometimes it's just alternative arguments and trying to develop those. Sometimes, like I mentioned before, it's just being a nice person and essentially, I'm not saying begging for forgiveness, but sometimes, sometimes
it helps.
Sometimes you got to grovel a little bit and see if you could, try to help your client. Another technique that I utilize is kind of like the shiny object technique. Let's say I know there's something wrong with the return and it's a large amount and the IRS hasn't necessarily looked at it yet, but maybe they will get to it if they keep probing and reviewing the return. Maybe I hold up an adjustment for them and say, well, you know what, as reviewing this return, we actually realized that this was improper. We shouldn't have done this.
Okay.
At that point, now the IRS is looking at this other object and they're not looking where we want them to not look, right? So there's the opportunity to, I'm not saying to be deceptive or lie, but I'm saying, hold up one thing so that maybe the IRS doesn't look at another. So I've used that to various degrees of success. Sometimes the IRS is going to catch the issue anyways, and there's really nothing you could do.
It's all strategy and it's all general strategies that you're just generally sharing with us. Obviously, it doesn't work 100% of the time. So we really appreciate you in sharing some of your techniques. Let's continue with this. So far, it's been fantastic. You've worked on a significant amount of cases, such as abating large penalties on foreign information returns. What's the most challenging case you've handled and how did you end up resolving it?
Sure. So there was a case involving one of our clients who received distributions from a foreign entity, and the IRS was arguing that they needed to be reported on the Form 3520. They were pretty much dead to rights because they did receive those funds from that foreign entity. But I was able to make a creative argument in that the funds didn't actually originate with these foreign entities that would have required the filing with 3520A. In fact,
Okay.
these were actually distributions from another entity that once you tiered it up through the chain, they actually were not reportable transactions.
Wow.
And
Yep.
I was relying on a case that was decided in bankruptcy court, which one ordinarily wouldn't rely on with respect to taxes. Now, there are tax matters that take place in bankruptcy court, but normally you're citing the United States Tax Court or the district court for the district in which your matter lies in. So I was able to find this complicated bankruptcy tax case involving the Wiley family, actually. And there was an argument in there about whether or not the transfer was direct from the entity that required the reporting obligation. And relying on that precedent, we were able to convince the IRS that our client actually did not have a reportable obligation. And the IRS abated about $850,000 in penalties in full. So it was for the IRS, nice victory for us against the IRS.
Yeah.
And what I was going to say is it made me feel good. One, because yes, I was able to save the client a significant sum of money, but also the creative argument in getting there. Tax practitioners and dealing with these foreign information return penalties will just try to blame the return preparer and claim reasonable cause because the return preparer failed to advise the client that they had this filing obligation. And those can be successful, but it's harder to prove. One, you need to be able to prove that the other advisor actually advised your client that they did or didn't need to file this form. So there's usually a lack of proof there. And two, you also have to show that you had an engagement with that prior advisor, which you may have had an engagement to prepare a tax return, but was there an engagement to render specific advice on the filing of this form? And I've had a couple of appeals officers take a stringent approach there and say, look, they're just engaged to file their tax return generally. You didn't produce any proof that this return preparer said, don't file a form 3520, for example. So therefore, you just don't have the requisite documentation or information for us to abate these penalties. Now, in that case, I was able to get a portion abated, but I wasn't able to get 100% abated because there's a lack of a paper trail. Kind of going back to our discussion at the beginning, that if you lack the records, it's going to be hard for you to obtain abatement in certain circumstances. And that was one of them. So it just goes to show you that having documentation is not only important for an exam, but also for like a penalty abatement notice, especially these foreign information return penalties, because they can be quite large. In certain cases, they're a percentage of the transfer. And so, for example, if you received a foreign gift, you have to report that in a form 3520. If you receive $1 million gift and don't report it, the penalty is 5% per month up to 5 months or 25%. You could have a $250,000 penalty right then and there. You may not have had any idea you would even need to report the gift because you would think, well, the gift is not taxable. Why do I need to report this? Well, according to the law. So yes, knowing those reporting requirements are very important. Those types of penalties are ones that I see quite often, actually.
Wow. Eye-opening. Let's talk a little bit about the employee retention credits, as this has been a hot topic recently. Can you share some of the trends or challenges that you're seeing in resolving these cases, or in fact, maybe even tell us what has been problematic and how to then move to resolving these issues?
Sure. The ERC employee retention credit space has certainly been vexing for taxpayers over the last year and a half since the IRS imposed their moratorium on paying claims, which they've since recently started paying claims again. But I think the biggest issue here is the IRS's inability to, let's say, handle these claims in a reasonable manner. And what I mean by that is the IRS received way more claims than they thought they would, and they weren't necessarily prepared for that. But at the same time, they have really taking a hodgepodge approach to resolving these claims. And that's created a lot of hardships for taxpayers. For example, at the beginning of the summer, the IRS started issuing denial notices. Those denial notices failed to include language that would afford the taxpayer the opportunity to appeal the matter to the Independent Office of Appeals. So you had many taxpayers thinking that their claims were denied and that they would then have to go litigate this in federal district court. The IRS failed to inform the taxpayers of their appeals rights. Very egregious. After they came out with an announcement saying, no, there are appeals rights, the IRS continued with their claim denial process, and they were issuing these letters 105C, and those are the letters in which they are officially denying the refund claims. Well, the IRS originally said that in order to appeal, you would need to produce information for every single quarter that you claim the credit, and that you would need to produce substantiation for every single aspect of the credit, even if the IRS claim denial notice only focused on one aspect or one requirement for claiming the credit. So now the IRS was asking for literally everything, even though traditionally when you go to appeals, you only submit information for the period that was denied and for the specific issue. It doesn't mean I'm going to now submit, when I go to appeals regularly, documentation for every single item of my tax return. No, I'm only going to submit it for this particular issue in front of appeals. Well, the IRS then had to walk that back and say, okay, we're not going to require you to turn over every single piece of information for every single quarter you claim the credit, but do so for the quarters that we denied. Turn over the relevant information. So there's been a lot of confusion. And that confusion has unfortunately created issues for taxpayers in trying to obtain the funds. And then you have a lot of statements by the IRS that I believe were not backed up by sufficient statistics. And that has tainted the revenue agents. And what I mean by that is you had Commissioner Werfel previously stating that 90% of claims were fraudulent. There's no evidence ever produced to justify that statement. But now his revenue agents, IRS revenue agents hear that statistic and they think any examination that they've been assigned to with respect to ERC involves some type of fraudulent claim. And you're having to educate the examiner that that's not the case and that you have a legitimate claim. And then you're having to produce the documentation to substantiate and establish your claim, but you're fighting an uphill battle because the agents are wrong. So, just statements, public, perception of the credit has created issues for clients. I think the IRS's haphazard approach to resolving these disputes has also created issues. And taxpayers have had to resort to the taxpayer advocate, getting their congressional representatives involved to help, process claims and get them paid out. And now finally, the IRS has started to release claim refunds over the last several weeks. I have several clients who have now started to receive those refunds. So it's a welcome change. It's a welcome change that they're paying out what the IRS has classified as the low risk claims. Then there's the high risk claims, and then there's kind of everything in between. What everything in between is, we don't necessarily know, but we would suspect the high risk claims are the ones that you've received denial notices for. For example, let's say you claimed, the credit on 30 employees, but only filed W-2s for 10 employees. Or then the IRS is using their computer tools to match that up and say, look, your claim is just too high. It can only be based on 10 employees, for example. But data analytics don't always work because I have several clients who are disregarded entities for federal income tax purposes, which means you're essentially a tax nothing, and all the results of that entity gets reported, for example, on an individual's 1040. Or if it's a disregarded entity of a corporation, that entity's results gets reported at the corporate level. So I have a few clients that are disregarded entities. They don't file their own tax returns. The IRS has denied those clients' credits, claiming that these clients don't operate a trade or business. The IRS thinks they don't operate a trade or business because they haven't filed a tax return. Well, of course they didn't file a tax return because they're not required to file a tax return. So this is
Sure.
something that the IRS could have easily have determined on their own, but they didn't. Now this claim denial letter goes out. Now my client has to respond to the letter. Now they have to fight for their credit when the reason for denial was, quite frankly, frivolous. So
Wow.
these are issues that, clients are facing with respect to ERC. There's just, I think, a lack of cohesive communication coming from the IRS, a failure for the IRS to appropriately address these claims in a manner that is not going to deny, which say legitimate claims. And this delay has essentially neutered the purpose for the program in the first place.
Absolutely.
Taxpayers needed the money years ago.
Right.
Now, they didn't get it. So now, maybe they've had to go out on credit in order to continue to operate. And they're desperate for this money because now they're having to cover interest costs or otherwise that this funding was supposed to address, 2021. And now that time has come and gone. So clients are, every day I seem to get an email from a client asking us to follow up on an ERC matter and to try to figure out where their claim stands, because you still have, thousands of claims that are languishing and the IRS has not addressed them. So there's a multitude of errors. It's kind of hard to just pinpoint one thing that's creating all these issues. It's quite frankly a lot that's creating problems for our taxpayer community.
Let's talk a little bit about businesses and high net worth individuals. What advice can you provide small to medium-sized business owners as well as high net worth individuals to better structure their financials to help minimize tax risks and penalties? And I know you mentioned already, of course, documentation, and then documentation. But
Yes.
Any other comments or advice that you can provide?
Sure. So one thing to keep in mind is that the IRS has been pretty consistent with their wording and statements since passage of the Inflation Reduction Act regarding who's going to be, I don't want to say a target, but who the IRS is more likely to look at for purposes of an examination. So with respect to individuals, the IRS has come out, well, the White House, then Commissioner Chuck Rettig, Treasury Secretary Yellen, each one of them made a statement that individuals who make $400,000 or less, the rate of audit for them is not going to increase. So when we're talking high net worth individuals, we're talking individuals who have a taxable income of $400,000 or more during the course of the year, because that's where the IRS is focusing its efforts.
Okay.
So in addition to documentation, the IRS has renewed its non-filer program. Individuals who have a taxable income of $1 million a year and have recognized tax debts at $250,000 or more, the IRS is actively trying to collect those tax debts in collections. So if you owe the IRS a large sum and you are a high net worth individual, you could eventually expect the IRS to track you down and try to collect on the matter, collect the debt. So if you fall into that category, getting out ahead of it, setting up a payment plan, putting yourself out of harm's way is one thing that you could do to avoid a revenue agent coming around and asking for payment. Same thing if you haven't filed tax returns. The IRS considers compliance to be the last 6 years. If you're a high net worth individual who hasn't filed and the IRS receives like a W-2 or a 1099 in your name, you can be assured that the IRS is now going to be sending you a letter requesting you to file a tax return for that year. So being proactive on those two fronts is something that you could do to mitigate one cost, because now you wouldn't have to necessarily get someone like myself involved. You could handle it on the front end, but it also will save you time and the effort of dealing with the IRS and a revenue officer who's trying to collect, who may require more information from you than if you had done the process or completed the process on your own on the front end. In addition to that, with respect to businesses, one thing that I've noticed with partnerships is the IRS has started this balance sheet initiative. If your ending balances don't match the beginning balances on your balance sheet, and you file that, it's on a Schedule L with your Form 1065,
Okay.
like your chances for an audit have skyrocketed. So
Okay.
simply just making sure all the numbers tick and tie is a great way to limit risk. The other thing with respect to individuals is you can request a wage and income transcript, and that's
Mm.
going to identify all of the information returns that were filed in your name. So sometimes high net worth individuals, they can lose track of their various accounts. I mean, I've got clients who have 50 accounts, so it could be difficult at times to
Sure.
keep track of all the 1099s that you are receiving unless you have some type of family office or otherwise, keeping track of everything. You can request a wage and income transcript, and that will let you know every information return that the IRS received. So this is a great way for you as like a backup to make sure that you're reporting everything, at least reporting everything that the IRS thinks you should be reporting. Those information, wage and income transcripts, are not perfect. Sometimes they do miss filings. So that being said, it's better than nothing, and it gives you a backup to make sure that you're properly reporting. And with respect to businesses, sit down with your tax advisor, with your return preparer. Right now, this is the time to do it at year end, and do some year end planning. Make sure that whatever structures you're instituting are well documented, that you receive whatever advice you think you're going to need from your tax attorney or advisor. You may want it in writing. That may be a tax opinion that gets expensive, but if you're entering into really large transactions, having that assurance from a tax opinion could be a worthwhile endeavor. And ultimately, what I'm getting at here is when you're sitting down with your advisors and alerting them to transactions on the front end and making your concerns known, it fosters a better return prep process, such
Sure.
that the return preparer is not missing anything, and such that the return preparer then has the opportunity to plan and to minimize your taxes in an appropriate manner. So constant communication with your professionals is really important. A lot of times what happens is clients will come in at the last moment with a plan that they want to institute or some documentation they recently found, and you're scrambling to get the return done. And maybe you don't put out a 100% accurate return because of that. Well, if you don't put out a 100% accurate return, the risk of an audit goes up, right? So
Sure.
making sure you do everything, on the front end with ticking and tying is really important.
So let's talk just a little bit more. What role does proactive tax planning, which ultimately sounds like really good bookkeeping, is a vital part of tax planning and tax preparation, and of course, tax avoidance. But in terms of proactive tax planning and avoiding disputes with the IRS, what are some of the additional tips that you haven't already talked about that you can recommend to the viewers and the listeners?
Sure. Well, if you're a really large business who's going to be entering into a multi-million-dollar transaction, one thing you should do is actually request that the IRS look at it on the front end. You could do what's called a private letter ruling, PLR, in which you are specifying a certain type of transaction to the IRS and asking the IRS to rule what the tax consequences would be. You basically lay out the proposed plan, the facts, the law, the analysis, and then the IRS will either agree or disagree. This is a great way to build assurance for the specific transaction that you're entering into. Now, of course, you got to be careful, because if it's aggressive and you don't think the IRS is going to approve what you'd like them to approve, well, then you just gave the IRS a roadmap for what it is you may or may not be doing. There's some strategy involved to whether or not you're just going to go right to a private letter ruling, but that is something that taxpayers who are entering into what I would call large transactions would possibly want to consider, because now you have the ability to lock the IRS in on how they would treat the transaction. And that may be important in order for you to facilitate a sale, for example, right? The other side may request a certain type of treatment. And if you're not certain whether that's going to happen, then maybe they won't close the deal. So, private letter rulings is another way for you to capture some type of assurance that what you're entering into is going to be respected by the IRS. Um,
That's expensive though, right? Having a private letter will, I
yes,
remember. Yeah, it's not cheap.
there's a user fee, which I believe right now it's like $38,000. And then of course you have to pay your professional in order to prepare the request. So yes, those add up. But if you're doing a, $20 million transaction,
Sure.
maybe it makes sense to spend $100,000. So that way, that $20 million transaction is not going to have any issues.
Okay. Fantastic. Entrepreneurs navigating the current complex tax laws. What are the most critical areas that they should focus on to protect their wealth and avoid any type of IRS scrutiny? And I know documentation, then documentation. Any other advice, fruitful advice?
Well, I think one thing now as we past election season and
Yes.
move forward and look towards so it's time to take a step back, actually. The
Yes.
last time President Trump was in office, he passed the Tax Cut and Jobs Act,
Yes.
TCJA. And those had a number of provisions that would sunset at the end of 2025.
Yes.
So now here we are again. Donald Trump has won the presidency. There's an expectation that he is going to extend aspects of the TCJA such that the tax rates won't revert back to what they were prior to enactment of the TCJA. So I think it's going to be very important to pay attention over the next 6 months to see what type of changes are going to take place within the tax law, because there's also 163J dealing with interest limitations, Section 174 dealing with capitalization. These were provisions that were impacted by the TCJA. Are those going to be allowed to sunset? Are they going to be extended? What is going to happen with other aspects of the tax code? All of this part of the Inflation Reduction Act, the Biden administration enacted a lot of green energy tax credits. Are those going to remain now that Donald Trump is in office and he needs to find a way to maybe possibly pay for extending the TCJA tax break? So the next 6 months are going to be very important, I think, for taxpayers to kind of understand where things are headed. Because once you obviously know where things are headed, then you could start to plan again. At this point in time, I'm trying to tell a lot of my clients to take a wait and see approach, because I think things are going to happen over the next 6 months. And when they do, they're going to happen quickly. And at that time, you're then going to need to be prepared. If, for example, the tax rates are not going to sunset, then there's one path. But if they are going to sunset, then maybe there's another path. So right now, it's wait and see. But I think moving into 2025, that's likely going to be the number one item on most tax attorneys' lists in terms of clients, what they're communicating to us, what their concerns are. And then also to kind of tie that to the IRS, we don't know if the IRS is going to maintain all the funds that were appropriated under the Inflation Reduction Act. So there was about $80 billion that was allocated under the Inflation Reduction Act.
Over a 10-year period.
Correct.
A 10-year period. Yeah.
And very important to point out, it's not like the IRS got $80 billion all at once, right? This was to be spread out over a 10-year period. It was to include enforcement upgrades. So that's more people, more revenue agents to do the examinations, but a lot of technological upgrades. I mean, the IRS is using antiquated systems. And so a lot of the money was to improve technology and then also customer service for anyone who's had to wait online or wait on the phone, for example, to try to get through the IRS. We know how long and frustrating that could be.
Yes.
We've already seen 20 billion of the 80 billion taken away as part of last year's debt ceiling negotiations.
Okay.
So does that mean more funding is on the chopping block? Possibly. Statements from, Donald Trump and some of his allies and surrogates while this funding was passed and since would indicate that they'd want to claw it back or repeal it in some fashion. That said, when you invest in the IRS, it does create revenue for the government. And so that's going to have an impact on the CBO, the Congressional Budget Office's scoring of the bill. So for example, if you take $60 billion away from the IRS, then you're reducing revenue. And is there going to be another revenue offset needed in order to balance the bill in order to get the overall tax package passed? We'll see. Maybe they keep some funding, but not other. Maybe they are able to find enough other offsets to completely strip the IRS of the additional appropriations. So wait and see. But the IRS has hired a lot of people this past year. They have opened a number of examinations. And even if funding goes away, you're still going to have these additional revenue agents and revenue officers on the payroll. I wouldn't foresee the government just outright firing people. That said, well, who knows?
We'll see what happens. Yes.
People have talked about abolishing the IRS. So obviously,
Yes.
that would mean everyone would be fired. But I would tend to think it's more of like a medium approach, like a happy medium approach where the Republicans are going to want to take back some funding, but I don't necessarily see them eliminating what's already come online. And so you're going to have an increased level of activity over the next few years, but not to the level that I think the IRS had originally anticipated.
Wow. So let's talk about the Tax Cut and the Jobs Act. There's a lot of airline true members that listens to this podcast, and we used to have this form called the 2106 for transportation workers, where we can take a lot of deductions for sort of unreimbursed employee business expenses and take that off. Since the Tax Cut and the Jobs Act has come to play back in 2017, that has gone away. What are some of the Tax Cut and the Jobs Act? This is a personal opinion only. What would you like to see this particular law, some of the laws extended, and what would you like to see some of the laws in this to let it sunset?
Right. So in order for the bill to be balanced the last time around, it was necessary to include some revenue raisers. And that would have been, for example, your cap on state and local tax deductions at $10,000.
The SALT tax.
The curb on Section 174 expensing. You could no longer expense it yearly. Now it has to be amortized over 5 years. You have the 163J limitations, which limits your interest income deductions. So a lot of these items, though, to me, I like to refer to the tax code now as almost like a robot, because it's just you just keep bolting onto it.
Sure.
And it just keeps getting bigger and bigger. To me, I would have preferred more of a traditional tax cut, but not having to redo everything that goes with it. In other words, not changing things just to change them in order to raise revenue, because businesses were hurt by the 163J limitation and were hurt by the inability to expense under Section 174. And to me, there was no economic reason to implement these changes. They were only done in order to raise revenue, to balance the bill, essentially, to make the top line number palatable for those voting for it. I would prefer to eliminate these one-off changes and to just, quite frankly, focus on rates, for example, because then that's going to bring back some simplicity as well to the tax code. I think a lot of the problems with the tax code is it's very complex. You have to get people like me in order to interpret it, because it's no longer just a matter of, oh, this is income and that's a deduction. There's very complicated provisions, thresholds, caps, what have you, that make it, let's just say, harder to complete one's tax return than in the past. So I'd prefer to see, just quite frankly, just playing with the rates and leaving a lot of the other provisions alone. I don't know how realistic that is, though, because as mentioned, there's going to be certain members of Congress who won't vote for a bill unless the cost is,
balanced.
Exactly.
Budget balanced.
And look, I'm not saying that it has to be zero. Like I would anticipate these tax cuts adding to the debt in some fashion, but there is a number at which certain members of Congress would say goes too far. So I'd be curious to see what's going to happen. I think a lot of people anticipate change, but how much change, that's up to debate. There may not be as much change as people thought.
Okay. When you and I met, we talked a little bit about the IRS listed transactions. Would you be able to enlighten us as to your knowledge of listed transactions and what your thoughts about some of these listed transactions are? And if, in fact, you end up having to represent one of these type of causes, how would you go about defending?
Sure. So a listed transaction is a transaction of interest that the IRS has identified as abusive. I think it's just the easy, generic way of understanding it. And the IRS requires taxpayers to report their involvement with these listed transactions on a Form 8886.
Okay.
That way the IRS knows who's involved with them. Now, a listed transaction doesn't necessarily mean that the IRS has the legal support in order to prevail. These are ongoing matters. So, for example, I was involved in basket option cases in which taxpayers were entering into these, let's just say, exotic financial products. And the IRS was arguing that there's no risk of loss here and that the tax treatments that the taxpayers were reporting was incorrect. Well, this is just the IRS's position. There hasn't been a case that's gone through the tax court that says you cannot have a basket option such as this. If somebody were to come to me and say, Michael, I've invested in this basket option, I need to disclose it. Well, we would disclose it. And then to the extent that this person was selected for examination, we would then go in and defend the position that either it's not a basket option because it's not similar to the item identified in the notice, the listing notice, or that the IRS position is wrong. And for example, that the way in which they tax basket options is not supported by the law. So just because you've entered into a listed transaction doesn't necessarily mean that you're dead in the water. Now, it could be that the IRS has since litigated some of the cases and has now built up case law such that you could have an issue, right, where you're going to have a much harder time getting out of it, and the likelihood of an audit adjustment would increase in those circumstances. But generally speaking, if you've already entered into the transaction, it is what it is, right? But if the IRS comes out and says, we're looking at this transaction, we think there's something wrong with it, it's probably best not to invest at that point in time, unless you start to see taxpayers in the general public not be audited, or if they are audited, the IRS is actually not making adjustments. Right. It's possible that there's been a series of events that would give one more comfort to know that the IRS has a weak position with respect to that transaction, for example. Sure. And so you'd be more willing to enter into the transaction than those in which, the IRS has a little bit more of a legal position for. So it depends on the circumstance and ultimately, what specific transaction, but generally you're going to have to report, and then generally more often than not you're going to be selected for examination because now you're in that taxpayer filing population that has indicated you've entered into one of these transactions.
Understood. Just to do a quick follow-up on listed transactions, we talked a little bit about conservation easements, the partnership, and specifically the syndication of them. They have recently changed the statutes for that sort of thing. Can you just enlighten us a little bit about, if you could just enlighten us on that particular listed transaction?
Sure. So the IRS for the past decade have been dealing with conservation easements, specifically syndicated conservation easements is what the IRS finds to be abusive, in which a partnership will purchase property and then syndicate or divide up its membership interest amongst various other taxpayers, such that you now have a piece or a portion of this partnership that is going to donate a conservation easement on a particular piece of land. What happens is the partnership will buy the land, made up numbers here, $1 million. They'll then syndicate the interests, put the easement on the land, and then claim a donation of 10 million, such that you've now 10x'd the value of your investment. And that donation, the deduction then gets passed out, proportionally to all the members in the partnership. That was the traditional syndication of a conservation easement. As you mentioned, David, Congress recently passed changes to Section 170 that would cap your ability to take a deduction on a syndicated conservation easement. I forgot if it was 3 or 4x basis but
Right.
essentially you're no longer going to be able to claim a deduction 3 or 4x your basis. So that is going to severely cut back on the number of taxpayers entering into syndicated conservation easements because, quite frankly, 3, 4x is still nice, but it's not 10x. So
Right.
people may want to invest their funds elsewhere. And so I think what we're going to see moving forward is the number of syndicated conservation easements are going to decline just because of that change in the law.
Okay. Fantastic. So what are some of the lesser known resources or tools that people can use to manage or resolve their tax disputes when they have been selected for examination?
Sure. I mean, not everyone needs to go out and hire a tax attorney to represent them before the
Like
IRS,
yourself.
right?
Yes.
It'd be nice, but look, for smaller matters, you're not going to want to pay somebody a large amount when, quite frankly, the amount at issue could be less than that, right? It's a cost benefit analysis.
Absolutely.
If you have never been involved in an IRS examination, honestly, the IRS website has a lot of useful information. There are publications. They, when the exam process begins, they'll issue publication 1, and some additional documentation, which thoroughly describes all of your rights during the examination process. It provides an overview and timeline of the examination process. Also, the revenue agent should be available to answer your questions about the process. I mean, they're supposed to put the S in service, right? I mean, that's really what we were told when we were there. It's part of your mission statement is to educate the taxpayer public. And so IRS isn't trying to pull one over on you during the examination. There's a lot of information available on the IRS website that will help guide you through that process, asking the agent. And then getting the agent's manager's information and asking the manager, for example, if you've got a question that you don't think the agent has adequately responded to. So there is information out there, and it could be a little daunting, obviously, having not gone through this process before. Big bad IRS, it has this negative connotation to it, but
certainly does.
I think for the most part, to kind of go back to what I said at the outset here, the revenue agents, they're just trying to do their job. And so they're not looking to get you. And therefore, they will provide you, answers to basic questions regarding the exam process and what you could expect along the way.
Okay. So if someone finds themselves under IRS scrutiny, what should be their first step? Contact you, contact Optimum Tax Relief.
It depends, right?
Who should they? Yeah.
So I think I kind of look at it on a tiered scale.
Okay.
So if it's an individual examination and you make less than $400,000 a year, then the IRS is probably only going to be looking at a couple items on your return, and you could likely handle that examination yourself. In that circumstance, you'd want to reach out to your return preparer and make sure to gather any records that they have. They may have work papers as part of the process of prepping your return. You may need that in order to respond to the revenue agent. They may also maintain certain documentation of yours if you don't maintain it yourself. So you'll want to reach out to your return preparer if you're going to handle the examination, or maybe even have your return preparer get involved and help you with this process. The next step up would be those who, quite frankly, would need to get a third party involved. Maybe it's a basic issue, so you could go to one of these tax resolution services, but more often than not, I mean, I kind of look at them as they're not like your return prep firm, right? So they don't have that history with you where your accountant, they know your filing history, they know your background. So the medium tier, it's probably best to have your return preparer handle the examination.
Right.
Then you get to the top tier. These are going to be your high net worth individuals, your large multinational corporations, large partnerships and S corps. These taxpayers are going to want to get a professional involved. Often they have their own internal tax department. They are maybe with the Big Four, and they have obviously all the resources necessary in order to fight a matter. Or you could seek a third party, someone who specializes in tax controversy matters, if it's like a really complex matter that you need to get a law firm, because there's a specific transaction that you're going to need them to research and opine on. So I think it depends upon the type of examination, some of the issues that are going to be examined, and then the amount of money at issue.
Sure. So what do you think about some of these type of IRS resolution services that's heavily marketed and advertised on TV and on the radio stations? What's your opinion about these type of services?
Yeah, I don't have the highest opinion of them for a
Okay.
couple of reasons.
Okay.
One, they usually don't have really highly technical specialists working there,
Okay.
such that if you were dealing with a complicated tax matter, I don't know that they'd be able to resolve it for you.
Okay.
Two, there's an additional cost involved because now you need to provide them with everything. Like, for example, when one of our clients is selected for exam, I already have all their documents in our case files. I'm
Sure.
quickly grabbing those and producing them to the IRS. Now there's additional effort because you've got to get documentation from your return preparer over to this other person. And this other person now has to review and understand it. Whereas I'm producing our accounting records. I know they're good. I don't need to I will look at them, but I don't need to spend an inordinate amount of time reviewing them because I already
Sure.
know where certain things are in the work papers and I could quickly, identify and produce those over to the IRS. So there's some timing involved there. I also find that they ask for large upfront deposits and don't necessarily provide you with a return on value.
Okay.
They'll just run through that retainer and then ask for another one. And you're kind of left wondering what just happened.
Okay. All
So,
right.
more
Sure.
often than not, I kind of, and maybe I'm just biased because I don't necessarily work with those tax resolution firms. And when I was at the service, I was only dealing with other tax professionals like myself now because I was with LB&I. So I was only dealing with really large examinations. So, I mean, for example, I'm not going to go hire some random third-party tax relief company to handle, a multi-million-dollar disguised partnership sale, for example. So
Sure.
it just depends. I'm not saying that they don't have a time and place. I think, like I mentioned, for smaller matters where you may not need to get your return preparer involved, but you may yourself not want to necessarily handle the day-to-day communications with the IRS, you could go to one of these third-party services and they would do that for you.
There's an article that came out a couple of years ago. It's in the Publica. And the article is titled, "If You're Getting a W-2, You're a Sucker." It was written by an IRS revenue agent. If you happen to have read it, I'd love to get your feedback on that. And if you haven't, then I'll share it with you after the fact.
I have not read that article, but I can only
I'll get that over
imagine.
to you.
Yeah, I can only imagine what it would be about. A couple of things come to mind, but one, I just know generally speaking, the taxpayers don't want ordinary income; they want capital gains.
Sure.
So W-2, that's all going to be ordinary income. It's going to be taxed at your highest marginal effective tax rate. Whereas, capital gains is either 15 or 20%, depending upon your bracket.
Sure.
Ignoring the net, income tax, the net. But yeah, I'd be curious to take a look at the article if you want to send it on over.
Yep. We'll do that right after this, right after the show here. Couple of final questions. What do you find most rewarding about your work in tax resolution and advisory service now that you're on the good side?
Yes.
Now that you're working with the taxpayers.
It's all in the eye of the beholder, as they'll say.
Yes.
Honestly, it's delivering the results that they're looking for. And that's representing them with integrity. Obviously, their most important consideration is whether or not there's going to be any adjustments. So helping the clients through the process, getting to the point where there's a no change, no adjustments. I mean, that's really because look, there's going to be times when an adjustment is warranted. And it is what it is. Maybe you made a mistake. It happens. Sure. Or you lack the documentation. It is what it is. And in those circumstances, there's really not much I could do. But I get the most benefit when the IRS thinks there's an issue, spends a lot of time developing it, and then ultimately you prevail because you knew you had the right position the entire time. And you just needed to educate the service with respect to that position. To me, that's where I feel like I get the most enjoyment with the job, and it's delivering that satisfaction to your client at the end of the day.
And what's one piece of advice that you would give our listeners and viewers about staying financially secure in an ever-changing tax landscape, especially with a new president-elect that's going to be taking place in the next month and a half or so? And there is obviously very polarizing thoughts about our tax laws in the tax landscape, what advice would you give?
Yeah, I think it's just being proactive.
Right?
When changes happen, you want to make sure that you understand what those changes are and how you could go about putting yourself in the best possible position such that you are not being taken advantage of and that you are taking advantage of the system to the extent you can. I mean, it maybe sounds awkward to say that, but at the end of the day, you're trying to minimize your taxes and put yourself in a position, whether it's, running a business, so that way you've got additional funds for yourself and for your employees, for example, or if you're an individual and you're trying to save for retirement and making sure that you have additional funds available for retirement. It's being on top of things. Don't put your head in the sand and act like the ostrich. And if you were to have a problem, you don't want to let it grow. Resolve your issues with the IRS at the earliest possible stage, such that interest and penalties don't accrue. And you get to the point where, clients get so overwhelmed by the amounts they owe the IRS that they just turn a blind eye. So whether you're dealing with something on the back end or changes on the front end, you want to be proactive.
And would you recommend young people that is just finishing college in tax law or in finance or accounting to join the IRS to obtain their experience so that they can follow the footsteps of what you have done yourself?
Yeah, absolutely. I would. The IRS was a great place to start my career. I don't have anything bad to say in terms of my time there and the position I had, the people I worked with. The amount that you would learn on the job at the IRS is far going to outweigh anything that you would learn in private practice. Every case I picked up at the IRS involved a new legal issue with a taxpayer in a different industry. And I had the opportunity to learn not only a lot about the tax law, but also about business and different types of industries in general, which have now allowed me to not only advise my clients with respect to, technical tax matters, but to come with a larger perspective. Now, having seen things in the industry and could say, well, I think a lot of people approach it in this manner. Have you thought about that? So I would never say to somebody, no, don't go to the IRS. I mean, you may not get paid as much as other places for starting out, but you can't trade that experience. You really can't.
Yes, absolutely. Okay, very good. What great comments and content that you have provided us. We want to thank you for tuning into this episode of the Jet Setting Wealth Advisory Podcast. Truly a special thanks to Michael Kramarz for sharing his invaluable expertise in tax controversy, dispute resolution, and strategic planning. If you'd like to learn more about Michael's work at Kaufman Rossin, please be sure to visit www.kaufmanrossin.com. And is there any way that you could provide us your email address? It will be on the screen.
Sure. My email address is mkramarz, Kramarz, @kaufmanrossin.com. And would be glad to sit down with anyone and talk over any IRS matters that you may have, or just general concerns with respect to your planning and future tax filing obligations.
Fantastic. My name is David Yu, airline pilot, founder, and wealth advisor at DTY Wealth Planning Solutions. Don't forget to subscribe to this podcast and leave us a review to help us grow. Stay tuned for our next episode, where we'll bring you more insights and stories to help you achieve financial freedom. Until then, keep soaring toward your financial goals and have a great rest of the day.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.